Welcome back to the channel. Today we're breaking down one of the biggest forces in financial markets, interest rates, and how changes in rates affect stocks, bonds, and investor behavior. By the end of this video, you'll understand what happens when rates rise and fall, and why markets respond the way they do. Interest rates are the cost of borrowing money. In the United States, the most watched rate is the federal funds rate, the rate at which banks lend to each other overnight. The Federal Reserve adjusts this rate to influence economic activity. Higher rates generally slow the economy, lower rates stimulate it. So what happens when rates change? Let's start with consumers and businesses. When rates are low, borrowing is cheaper. Consumers buy big-ticket items like homes and cars, and businesses invest in growth. This increases overall economic spending. When rates are high, borrowing becomes more expensive. Consumers and businesses scale back spending, slowing economic activity. Now let's connect this to the stock market. When interest rates rise, companies face higher borrowing costs and consumers spend less. This can lower corporate profits, reducing expectations for future earnings, and stock prices can drop as a result. Conversely, when rates fall, borrowing becomes cheaper, spending increases, and profit expectations can rise, often pushing stock prices higher. Keep in mind, markets are forward-looking. Sometimes prices adjust before the rate change is official, as investors anticipate the move. Stocks aren't the only asset class affected. Let's talk bonds. Interest rates and bond prices have an inverse relationship. When rates rise, new bonds offer higher yields, making existing bonds with lower rates less attractive. As a result, existing bond prices fall. When rates fall, the opposite happens. Existing bonds become more valuable and prices go up. Not all stocks react the same. Some sectors benefit from higher rates, like financials, which can earn more from lending, while interest rate-sensitive sectors like utilities and real estate often struggle when rates rise. Another crucial link is between interest rates and inflation. The Fed typically raises rates to cool off inflation. Higher borrowing costs reduce demand, which helps bring inflation down over time. When inflation is low or slowing, the Fed may cut rates to encourage growth. To recap, interest rate hikes tend to slow economic activity, pressure stocks, and reduce bond prices. Rate cuts can stimulate growth, lift stocks, and increase bond prices. Markets can move ahead of rate changes as investors form expectations. If you found this helpful, like and subscribe for more market breakdowns. And let me know in the comments, what interest rate topic should we explain next?